Hello, I'm Tony Kay. Welcome to the Economic View. I'm joined by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Interesting night. We had
Interesting morning.
Yeah, very interesting. The Fed, we knew it was coming along, but finally the Fed, Janet Yellen, has confirmed what we all knew, that they're going to start unwinding the balance sheet.
They have, and she's confirmed what we knew and a little bit more. It gets people like me a little bit excited. I know it's a little bit nerdy, but I think you need to look at, so let's very quickly run through. As expected, they are going to start moving on their balance sheet. So it's just shy of 4.5 trillion US dollars. And we knew that was coming. They've been telling us that for at least the last sort of 12 weeks, which is why the Fed, I think, is actually one of the best central banks around. They are very structured with their communication. So nothing new there. $10 billion a month. It'll change every quarter. It'll move to 15 bill and so on and so forth. As you and I were talking about, though, that takes a long time to unwind.
Many years.
Many decades to get there. So it's a very slow process. It is also now a known seller, and that was what you would expect with the reaction in the Treasury market last night. You saw a fairly reasonable spike up in US Treasuries, which is what you should expect, particularly the longer dated. So everything was textbook there, and that was well done. It's why it's probably not as big a deal as I was hoping it was going to be, but that's fine. What was more interesting was the dot plots, which is the charting forecast from the actual Fed members themselves. Each one of them get a chance to lay out where they see rates over the coming 3 years. There was a change there in the fact that they saw 2019 move away from 4 rate rises to 3, and the rate a bit lower, but they kept a rate rise in 2017. So 12 out of the 16 voting members still believe rates will be higher by the end of the year. And that therefore saw December pricing really spike up. So the market's been really pessimistic around the Fed and the ability to actually believe that economic growth and that inflation materialization was going to be allowing them to do another rate rise. So the market was a bit scrambly last night. So that's the main sort of scenario. So everything was fairly succinct in terms of how she alluded to it. And the other thing I've been sort of fairly open about is there is a political element to it, in the fact that President Trump basically hasn't seen her since their initial meeting at the start of the year. That means that her tenureship could possibly end in February, and she was asked that. She's very good at keeping a straight bat. So it was a very structured meeting, but it did make the markets wake up to the fact that the Fed is hawkish, the Fed sees growth, the Fed is on its current path. It did downgrade inflation slightly, so to 1.5% rather than 1.7 for this year, and to 1.8 from 1.9 for next year. GDP growth also off 0.25% across the estimates, but in the main, they are hawkish and they are fairly rosy about the outlook, and that will affect us.
So let's look at a few things here. First of all, US rates really coming off a very low base.
Very low base.
When rates continue the rise in the US, we're still talking about fractional increases. But I also wanted to talk about a few other things. So in Europe, they're still in the situation where their programs are still running.
Yes.
And when that changes, we don't know. But I suppose this is going to be a trigger point for them.
It is. It's a trigger point for the ECB, and they've been starting to talk about it as well. So Mario Draghi, he actually said that they will address it in the October meeting at his last sort of major press conference, which was last month. They actually have a meeting tonight to watch that. There's nothing changing. It's not a changing meeting. It's just it's a board meeting, but they're in there as well. And the reason it's all very interesting is that central bank's main focus is financial stability. We've had a very unstable decade, well, nine years with the GFC and the post-GFC era, and they have done probably the right thing in terms of creating financial stability by providing as much liquidity as they can and easy access to credit, trying to sort of reduce that burden and slowing that market down. The tricky question for them now is how you unwind that without creating financial peaks and spikes, both up and down, will be a very interesting thing for them. Not only that, you've also got to remember they need to continue to see growth moving. And what we're also now hearing, and this brings back to yesterday with Lucy Ellis here in Australia with the RBA, talking about there is now clearly a structural change in what is new world norm for economic growth. So, your pre-GFC and the normalization there and post-GFC, they're now trying to tell you are different. So, your inflations for an Australian-centric point of view of, trimmed inflation being around 2 to 3% may have to be revised. The US, the same principle. GDP growth being around globally 3% may have to be revised as well. And we are now in a different environment. So the other thing that everybody's talking about, ECB, BOE, RBA, Fed, is around the normalized cash rate. So that's the cash rate with inflation inside of it. Now we are technically below our normalized level, and it's certainly part of the reason why we're talking about rate rises here as well. The Fed is still below what they believe it, but they are downgrading it quite regularly. So the Fed last night, another part of what they talked about and why rates might not move as fast as they were expecting, is that they now believe the normalized cash rate, so the neutral cash rate, what would be, basically the cash rate with inflation inside, is 2.8%. They originally referred to it as 3%. We here in Australia are now facing the same scenario where the RBA, they believe it's 3.5%, but if you had gone pre-GFC, it's 5%, and it's coming down at a fairly regular clip. So this is the other interesting debate, and all this kind of material around forecasting what now is the neutral cash rate is getting harder, because in the post-GFC world, inflation and GDP just don't move like they used to.
Yeah, it's a different normal.
Yeah, it's a different normal. And how do you rebase to that? That's the question.
Yeah. So the OECD also came out with their own report and was saying essentially that we're getting back to this word normal, we're returning to a more normalised structure.
Yes.
Whatever that is.
Whatever that is. And that was, again, it sort of feeds into all this idea that we are returning to trend growth, employment, inflation is all moving back to sort of trend. That's all well and good. But if you look inside it, they actually have 3 charts in that: 30-year, 10-year, and 5. So 5-year is actually at trend, which makes sense considering that includes the GFC and what has been a pretty rampant growth for places like the US, Europe finally catching up, etc. But on a 10-year basis, we're moving towards that trend area. 30 years, however, we're not, and that's fine. I mean, if you look through again, getting back to this whole idea, globally, interest rates and what is the normalized cash rate has been plummeting for 30 years. It's not a new thing. I know we've discussed this on this program before, that interest rates globally were in double digits back in the 80s. And now we're talking about interest rates globally sort of hovering at an average of around about sort of 2.5%. That needs to be also factored in. So the OECD is correct in saying that, but we do have to get ready for the new norm. So the question therefore becomes, as you and I and what we're looking at in terms of the individual, what does that mean for interest rates? What does that mean for investment? What does it mean for the expectation of growth? That's what they're now trying to factor in and trying not to stifle that.
Yeah. Well, that's what I wanted to get to next.
Yep.
What does all this mean for the retail investor?
Yeah.
Or not just an investor, just for the ordinary person with a mortgage, with credit card debts or whatever. We're going to see that trend upwards, I suppose.
We are, and we've already technically seen it. So I always look at it from an Australian-centric point of view, because I think it's the easiest way to explain it, because we unfortunately just don't have enough capital in this country to meet the lending requirements that we want in this country. So we have to go to the wholesale market. So we're very lucky that almost 65% of our market, our lending market is made by retail, but wholesale is getting more expensive because interest rates are global when you go to the wholesale market. Now, our big 4 banks, the majority of where they borrow when they issue new capital is actually in the US. They have been a little bit more sort of sophisticated and gone to Europe as well to try and diversify that risk, but we've now got both of those areas, nation and an area, that's going to raise rates. That means that the borrow rate that the banks get will increase, and that therefore means the coupon rates are higher. They're going to have to pass that through, because it means that the net interest margin, so the difference between what they borrow and what they lend out to you and I as mortgage holders, or in corporate lending, whatever it is, that will get narrower. So they need to sort of offset that. So we've seen already in the last 18 months, when the Fed has raised rates, that out of cycle rate rises for corporate borrowing. So interest-only loans, investment loans have been the ones targeted, but even owner-occupier have seen rates increase ever so slightly, and you will therefore probably expect that to happen. So what does that also therefore mean from an RBA perspective, with the fact that we're now forecasting, or at least 2 big major banks are, with NAB and ANZ, and they go hand in hand with Goldman Sachs and Deutsche Bank, who all believe in 2018 we will see rate rises as high as 75 basis points. The 2 major banks are saying 50. NAB's saying actually 100 over a 2-year period. All of that will be conditional on the effect on the household. Because it gets back to debt and the debt that we hold, it will put us under a bit of pressure and it will tighten. That's not a bad thing. It just means that it will slow growth down. And that's, again, financial, from the whole conversation we've had this, financial stability is the core mandate of a central bank. And if financial stability has been maintained by market structures, the RBA probably won't have to move because it's actually happening independent of it.
There's a whole discussion, we won't do it now, but there's a whole discussion about what the banks here may do and may not do in terms of raising rates because of the ramifications for the whole economy and for their own balance sheet, weighing that up with shareholder interests. It's very
the triangle. I think Ian Narev has a really good, he calls it the triangle, which is the shareholder, the mortgage holder, and then also the term deposit holder. And you're exactly right. Where do they target in that triangle of making sure they maintain a fairly even structure? So it is for another debate. What I would say though, the other question that's now coming, which is a really positive thing from the Australian equity perspective, all the central banks are suggesting inflation is coming. And in a moving and growing inflation environment, you want to be exposed to value stocks. And I've spoken about this before. We are probably one of the best value markets around. We offer you 4.3% on the ASX. It's well ahead of pretty much every other global market. So it may actually see some fund flow in getting that value exposure, because in a low inflation environment, you want exposure to growth. And that's why Asia, the US is doing so well. They are growth markets. So that's actually something that may be a positive out of this whole situation, is that we may actually see fund flow in, investment fund flow for our market on the back of it.
Thanks again, Evan.
Thank you, Tony.
Join us again next time for the Economic View.
Did you know that your membership gives you access to InvestSMART, Intelligent Investor and Eureka Report? Just use your original login details on all 3 sites or go straight to investsmart.com.au, where you'll find all of our content, no matter where it's published first.